Welcome to this introductory video explaining the basics of the T-cycle analysis. My name is Dario Pressato and I'm the founder of Tradomics, a group of professional traders specialized in the stock market. If you have landed here, it's because you're curious to better understand what this technique is and how it can be used to analyze charts. Therefore, let's get it started. First, let's delve into a bit of history. It all began in the 1930s when Elliott started working on the wave analysis. During the same period, Gann developed his theory of Gann angles and mastered the charting techniques. But the pioneer of the cycle analysis was Hurst, who in the 1975 realized that the market could be studied through cyclical phases, each with a specific time frame for completion. And since then, many engineers and traders have further refined the technique. So over the years, for example, Tradomics has introduced new elements to tailor it for the stock market. So our goal is to ensure that those entering the financial market are fully aware of the risks and opportunities it presents at any given time by predicting the duration of specific market moves. So now let's jump to the chart analysis. The T-cycle analysis is a technique that decodes price fluctuation throughout the days. In all the videos we will be publishing, the keyword days is the mantra that allows us to calculate statistically by when to expect a certain move. This type of technique has been developed as an answer to estimate and interpret the market fluctuations that are managed by big operators, such as the hedge funds or banks, that use algorithms like HFT or high frequency trading that must abide rules and mathematical parameters for their functions. In our analysis, we will demonstrate that besides graphical elements, it's all a matter of time, and it's all a matter of countdown. There are windows of time in which algos buy and other window of time in which they turn into selling mode. You will be also surprised, and we will demonstrate it, that in particular moments where a certain setup occurs, neither the earnings released, especially in the short term, can affect or change the development of a trend. We will also show that news do not affect the course of the cycle. Therefore, you can simply rely on mathematical parameters like algo does to study the chart. So this is one of the big advantages over the other techniques like the Elliott wave or the technical analysis. So let's focus now on the chart of Apple and let's see how we framework the chart in cycles. In all the videos that we will be issuing, on the right hand side you can see a legend of cycle duration expressed in days. We have also special cycles that are called hybrid cycles that are between a cycle of a degree lower and a degree higher. A T plus 5 is it's an yearly cycle between 190 and 338 days. Um, T plus 4 is a 6-month cycle between 94 to 168 days, and a T plus 4H between 169 days to 189 days. A 3-month cycle is between 48 and 89 days. A monthly cycle is between 24 and 44 days. A bi-weekly cycle is between 13 and 22 days, and 1 week or a weekly cycle is between 6 and 11 days. When we talk about cycles, we have to define two different types: the downward and the upward cycles. So in here, the downward cycle are connecting low to low, whilst the upward cycle are connecting top to the top. We can always gauge their duration. In this case, we have at the T plus 3 cycles of 30 days, and the upward cycle, the corresponding upward cycle, here we have at 66 days. Now, what is important to know is that when for the downward cycle, its conclusion is higher in terms of level of price compared to the low from which it started, we can call it positive. Whilst in this case, in the upward cycle, is the other way around. So if the top of its end is lower compared to the top from which it started, then we can consider it as a negative upward cycle. Another case is this one, where we had a downward cycle where it ended at a price that was lower compared to the price from which it started. Therefore, this is a downward negative cycle. But we can also have an upward positive cycle. Like in this case, we have had a nearly upward cycle where its extreme top ended higher compared to the top from which it started. So in this case, it's positive. When we talk about the duration, and here we can gauge the duration that was 239 days. And when we compare to the legend here on the right hand side, we can say that we have an higher likelihood that the cycle will terminate its development within the medium time. So if we have 190 days to 338 days, the median duration is between 230, 250 days. And here we can expect a higher likelihood where the cycle will end. It's a little bit more seldom that the cycle will end close to its minimum or maximum duration. We have to keep that in mind because this helps us tremendously to manage our position, whether they are long or short position. Another important thing to mention is how many days do we need to identify whether a supposed or unexpected cycle is in development. So let's take, for example, again, this downward 3-month cycle. In order to have a 3-month cycle here, we need also from a graphical perspective, some bars, a certain amount of bars that are higher compared to the lower price from which it started. And how many bars do we need? Well, we need a subcycle of 2 degrees less. So if we are expecting that here from this low, a T plus 3 is in development, then we need a minimum duration of 13 bars, like a T plus 1, so 2 degrees less. So T plus 3 minus 2 is a T plus 1. That must be higher compared to the lower point reached. So graphically speaking, here we have a T plus 1. This T plus 1, all the bars encompassed in the T plus 1 are higher compared to this lower price of $114. Therefore, here we have the sufficient and necessary condition to have a T plus 3. So this T plus 3 particularly was positive, but as a general rule, if you wanted to understand whether a cycle is in development or not, you need to have 2 degrees less in terms of duration for its development. In this case, for example, we have had a negative downward cycle, but we have had at least 13 days, so 13 bars higher to this point, and that's why this helped to understand that this one was a T plus 3 because this necessary condition was already abidden. So after it, we had a downtrend, and the conclusion of this T plus 3 ended after 65 days. Another really important, and this is the tremendous advantage that we have with this technique over the others, is the following. So let's consider the upward cycle here, the yearly upward cycle. We have had a breakup of the top after 114 days. So here we were expecting a T plus 5 upward cycle. And with this bar that occurred on the 7th of July 2021, we broke up the top from which it started before its minimum duration. So we know that the minimum duration was 190 days, and we broke up it after 114 days. Therefore, if there is such condition, we can say that the extension of the cycle will be in the same direction in which we had the breakup. So in this case, the breakup was on the upper side, and therefore what happened is that the extension of the cycle over its minimum duration in this case have been to the upper side. This means that we could have opened long position all the way through until its minimum duration and even beyond in order to gain money. The same condition has been here. So we broke up this minimum or this low after 41 days. So if we had open a short position here, we could have stayed in the position until its minimum duration, and the minimum duration was 48 days. So we could have earned money by simply calculating the time, and we could have stayed in the position not just for the 48 days, but even beyond the 48 days. So this is a tremendous advantage that we have over other techniques. I keep repeating it because with the technical analysis, we could have had a breakup of the support here. But in this case, you know how long time you can stay in the position without having higher risks. And therefore, you can manage the position accordingly and maximize your profit, or avoid to stay in a position that and it doesn't, there is no mean to or stay in a position that is not longer pay you out, because by measuring the time, you know how long the price can stay in a downtrend or in an upper trend, and then calculate also your risks to stay in a position or not. Lastly, there is another thing that deserves to be mentioned, and this is the symmetry. So sometimes there is a symmetry, a specular symmetry between upward cycles and downward cycle. For example, here we had a T plus 5 as an upward cycle, and here we have a T plus 5 downward cycle. Here we had a T plus 3 with a T plus 3, a T plus 2 with a T plus 2. So sometimes, especially when there are not particular volumetric tendency or stronger volumetric trend to the upper side or to the lower side, we can recognize a certain symmetry. Some other times, not really. So for example, if we take here the lower occurred in January 2023, from January 2023 until its stop in July, we have had 6 months of extreme upside trend. And in this case, we haven't had the right time to uh, begin a 3 month cycle. But from here, we have had just a 6 month cycle, and in between, just monthly cycle. So first monthly cycle, second monthly cycle, third monthly cycle. That's why we haven't had time actually to stay lower to this top, for example, for a minimum duration to start a T plus 3. So a T plus 3, a 3 month cycle, needs at least a T plus 1, so needs at least 13 days lower to the top in order to be defined as such. But in this case, we have had just 10 days, and 10 days lower to the stop was the enough duration for a T plus 2, but not enough for a T plus 3. We have had the same condition here, and we have had differently here the necessary condition to have a T plus 4, because here we have 30 days. And this strong tendency was given to the fact that even in this condition, we have had a yearly cycle that was broken after, so where its top was broken after only 97 days. And as you can see, the extension of the gains have been to the upper side for a total duration, in this case, of 284 days. By measuring the time and having such conditions, you are pretty sure that you don't expose yourself to risk of a reversal or a trend reversal, but you can stay in the position by measuring the time. So having said that, we are about to conclude this intro video. There is another special element that it's important to mark, and these are the so-called Bayes tongues. So the Bayes tongues are the market anomalies. So these are the time extension that fit between two different cycles, and their purpose is to extend the duration of the cycle itself. In general, they are more frequent with between a longer cycle like a T plus 6, a T plus 7, or a T plus 5, or a T plus 4, but it's not given by fact that it can occur only between long cycles. So they can occur even between shorter cycles, even if they are not so frequent. And what is important to note is that their duration is always 3 degrees less, so 3 degrees shorter compared to the cycles we are comparing. So a Bayes tongue can actually be included, let's say a Bayes tongue of a T plus 2 can be included between two cycles of a T plus 5. So a monthly extra time can be included between two yearly cycles. And here we have an example. We always flag this market anomalies with in red. This was, for example, a T plus 4 time extension or Bayes tongue between a T plus 7 and a T plus 7. Now I will show you how it works in this particular case. So if we go back, especially to this point, we see that there is a big cycle that ended here. So it ended in 2023, but it started in December 2018. 2018 to 2023 is a T plus 7. So the T plus 7 in between 3 to 5 years. We have had this first B yearly cycle. Then we have had another yearly cycle here, downward cycle. Then we have had another downward cycle here. Let's gauge the time again. The first yearly cycle took 240 days. The second yearly cycle should have lasted 325 days. But from here, we have never had another yearly cycle. And from here to January 2023, we would have had 460 days, which is not anymore a yearly cycle. It's definitely more because the limit is 338. Now, here we have had a Bayer tongue. So this particular cycle has been a T plus 4, which was able to connect a T plus 7 and another T plus 7. So from here, we have evidence that a cycle of 3 to 5 years is in development. And in October 2023, we have had the closing of the first yearly cycle. So we have always to bear in mind that Bayer tongues are really insidious. They are threatening our trading, and on top of it, they cannot be foreseen. But we have always to bear in mind that there might be the possibility to have extra time between cycles, especially of longer duration. And these are the fake moves of the markets. So in that case, they do it on they do it because they want to put the traders in trap. So it's a fake move with a up. In this case, was an upper move, then a down move, and then an upper move. And generally, if you are aware of the technical analysis, Bayer tongue of this kind can be also defined as a double bottom. So first bottom, fake move, then back again, and then back up again. So and that's as how we call it a downward cycle. But in the technical analysis, it's 1, 2, 3, 4, double bottom. Okay. So I hope this video has given you a flavor of how the T-cycle analysis works. If you liked it, please subscribe to our channel also to be informed about the latest analysis we will be issuing on the stock market. Thanks again for watching and see you to the next.